You work hard, you get to the end of the week, and you expect to see the full fruit of your labor. But when that physical paycheck finally prints, a very noticeable chunk of it is already gone before it ever reaches your bank account. That missing money is tax. It is the mandatory, non-negotiable subscription fee required to keep human society running. The government collects those funds to pay for the collective goods and services we rely on every day, things like housing, public schools, hospitals, police, firefighters, and even space programs. Surrendering a percentage of your individual capital is the baseline rule of modern life. Everyone pays into the system to maintain the collective infrastructure we all use. Income tax is the primary way the government collects this fee, skimming money straight from your paycheck. But almost everyone misunderstands exactly how their specific tax bracket calculates what they actually owe. This is a diagram showing the most common mathematical mistake people make. Let's say you earn $100,000 a year and fall into a 22% tax bracket. It seems logical that your entire income is taxed at that rate, meaning you owe the government $22,000. But income is actually taxed in progressive tiers, known as marginal brackets. The system works its way up from the bottom. That first $10,000 you earn isn't taxed at 22%. It is taxed at exactly 0%. You pay nothing on that bottom tier. The math changes as you move up the ladder. The next $40,000 is taxed at a lower 12% rate. It is only this final $50,000 chunk at the very top of your income that gets hit with that highest 22% penalty. So instead of $22,000, your true total tax bill is a significantly lower $15,800. This progressive system protects baseline survival income, ensuring those who earn less pay a smaller percentage. But this standard calculation is just the raw default state of the board. Next, you have to factor in the modifiers. If you are an employee, the government automatically deducts taxes from your paycheck. But if you own a business or work as a freelancer, you have to self-report your annual earnings to institutional authorities, like the IRS in the United States, so they can manually calculate your total. This self-reporting phase is where you can use deductions. A deduction is a legal modifier that allows you to lower your total taxable income score, shrinking the pile of money the government is allowed to calculate your tax against. You cannot claim personal wants or luxury purchases. The rules strictly require these to be work-related expenses you had to buy for your job, things like mandatory uniforms, specialized tools, training courses, or travel and accommodation for business. By providing the receipts for these operational expenses, you actively shrink the income the government can see. If you effectively lower that number, the system is forced to recalculate and issue you a refund for any taxes you overpaid throughout the year. The government activates secondary collection tripwires the moment you spend or invest your money. You pay sales tax on consumer goods, a property tax on a home, corporate tax on business profits, and inheritance tax on passed-down money. Authorities also deploy targeted penalties. Environmental taxes penalize corporations for polluting, while luxury taxes and tariffs are designed to financially punish and discourage the purchase of excessively expensive items or imported goods. The system aggressively enforces these rules through the tax audit. If a citizen claims highly suspicious deductions or tries to hide secondary income streams, the government will trigger a mandatory line-by-line investigation of their finances. Failing that audit sets off an escalating chain of consequences. It starts with an official warning. If the debt goes unpaid, they charge compounding interest, causing the total owed to multiply. Eventually, the state steps in and forcibly seizes your personal assets to cover the gap. Total non-compliance or deliberate evasion of these laws triggers the absolute final penalty of the system, federal imprisonment. The entire machine sustains itself through this inescapable web of daily transaction tripwires, all backed by the constant, severe threat of institutional force. While average workers navigate strict wage rules and the constant threat of an audit, the ultra-wealthy bypass the standard system entirely. They operate under a completely different set of mechanics because they do not rely on standard paychecks to generate their money. This chart shows the dramatic difference between standard income and capital gains. Capital gains occur when the wealthy sell off held assets, like stocks or property. Because this money comes from an asset sale rather than a weekly wage paycheck, the profits are taxed at nearly half the rate of standard working income. They also utilize complex strategies like negative gearing. A rich investor will buy a piece of real estate and intentionally rent it out for less money than it costs to maintain. They are actively losing cash on the rental, that they use that exact loss to create a massive deduction against their other taxes. They happily absorb this short-term operational loss to avoid paying current taxes. The endgame relies on the property's overall market value steadily rising, allowing them to sell it years later for a massive, low-tax capital gains payout. At the highest levels of wealth, the tax code stops functioning as a rigid enforcer of civic rules and transforms into a strategic, legal sandbox for asset management. The ultimate loophole, however, is geography. Tax rules are bound by borders, and different nations demand different contributions. Countries like Finland or Japan claim over half of their highest earners' wealth to fund massive, comprehensive public services. Global elites and massive corporations counter this by simply routing their wealth to offshore tax havens. In places like the Cayman Islands or Dubai, the mandated tax rate on income is literally 0%. For the average citizen, packing up for an offshore haven isn't an option. You cannot escape the system. Your only practical defense is meticulous budgeting, tracking every operational expense, and aggressively claiming your own legal deductibles. Taxation is a framework of rigid defaults and strategic exceptions. These baseline rules ensure the average worker funds the infrastructure of civilization, while the selective exits in the law ensure that those with the right assets are the ones permitted to keep them.